Brent crude crossed $110 a barrel on Tuesday. The Bank of Canada is expected to hold rates steady on Wednesday. Those two facts should not coexist comfortably, and the reason they do reveals exactly where the Canadian economy is stuck. When the U.S.-Iran conflict choked off the Strait of Hormuz in early April, roughly 14.5 million barrels per day of Middle East supply went offline. Goldman Sachs now tracks global inventories drawing down at 11 to 12 million barrels per day, a pace the bank calls one of the largest single-cycle reversals it has flagged in years. Goldman revised its fourth-quarter Brent forecast to $90 per barrel, up from $80, but spot prices are already trading well above that call. Brent hit a 2026 high of $138 in early April before settling into the $103 to $111 range as peace talks stalled. In Canada, that oil shock is traveling directly into headline inflation. The national figure rose to 2.4%, driven by gasoline prices at the pump. That number is high enough to keep the Bank of Canada from cutting, but it is not high enough, and the broader economy is not strong enough for the bank to hike. GDP growth is tracking around 1.5% in the first quarter, population growth has turned near zero, and the trade shock from U.S. tariffs is still compressing exports. RBC Capital Markets head of North American Rate Strategy, Jason Daw, puts the base case plainly. The Bank of Canada holds for all of 2026, with rate hikes deferred to 2027. The only scenario that pulls hikes forward is a sustained second-round pass-through from energy into core inflation, and that has not materialized yet. The Canadian dollar fell to 73.06 cents US on Tuesday, down from 73.34 the session before. The mortgage market is watching the same signals. With the BOC on hold and oil keeping headline inflation elevated, the spread between variable and fixed rates is compressing, leaving borrowers in an awkward equilibrium. The oil price is high enough to hurt consumers at the pump. It is not high enough to justify the kind of tightening that would restore credibility against a potential inflation overshoot. That gap, between what energy prices are doing to costs and what the central bank is willing to do about it, is the defining tension in Canadian macro right now.
While bond traders were pricing a frozen Bank of Canada, Shell made the largest corporate deal in the Canadian energy sector this year. The British oil major agreed to acquire ARC Resources for $16.4 billion in enterprise value, $13.6 billion in equity at a 20% premium to ARC's 30-day volume-weighted average price, plus $2.8 billion in assumed debt. Shell CEO Wael Sawan framed it directly. ARC Resources is a top-quartile, low-cost producer in the Montney Shale Basin, adjacent to Shell's existing Groundbirch and Gold Creek assets, and critically, it feeds directly into the LNG Canada liquefaction plant. The timing is not coincidental. The same week Shell announced the deal, its CEO told investors there is growing confidence in Canadian LNG prospects. That confidence has a geopolitical foundation. The U.S.-Iran conflict has exposed how fragile Persian Gulf supply routes are. Canada's Montney gas, piped west and liquefied at LNG Canada, represents a route that does route past the Strait of Hormuz. For Asian buyers who rely on that strait, Canadian LNG is not just energy, it is supply chain diversification. Shell is betting that structural argument survives even if the Iran conflict eventually de-escalates. The ARC deal adds roughly 2 billion barrels of oil equivalent in proved plus probable reserves to Shell's books. ARC's 374,000 barrels of oil equivalent per day of production, with liquids at 40% of output and 70% of revenues, supports Shell's target to maintain 1.4 million barrels per day of liquids through 2030. The production growth CAGR moves from 1% to 4% relative to 2025 levels. For Canada, the deal lands at a complicated moment. The same week Shell was signing, an analysis from Energy Now documented that Canada lacks both a strategic petroleum reserve and meaningful spare pipeline capacity, meaning it cannot contribute effectively to IEA emergency supply sharing, despite being the world's fourth largest oil producer. British Columbia is also adjusting gas tax policy amid the LNG race. Prime Minister Carney has staked his energy policy on exactly this kind of foreign investment into knitting and hydrocarbons. Shell Steel validates that pivot, but also underscores how dependent the strategy is on private capital rather than state infrastructure. The UAE announced it will exit OPEC as of May 1, its production no longer constrained by cartel quotas. That adds one more variable to the global supply picture that Canadian LNG is positioning itself against.
Gold dropped $84 on Tuesday to $4,595 an ounce. That is a notable decline on a day when oil surged, the dollar was under pressure, and equities fell across technology. The sell-off pulls gold back from its January record high and has erased roughly two-thirds of the gains made since the start of the year. The explanation is not a reversal of the macro thesis. It is a reminder that real yields still set the ceiling for gold in the short term. Deutsche Bank published a note this week projecting gold could reach $8,000 per ounce within 5 years under a de-dollarization scenario. The mechanics: central banks have added over 225 million ounces to reserves since 2008. Dollar holdings have fallen from above 60% of global reserves in the early 2000s to roughly 40% today. If that share continues declining and gold's allocation in central bank portfolios rises from 30% to 40%, Deutsche Bank simulation puts bullion at $8,000. Russia and India, Kazakhstan, Saudi Arabia, Qatar, Egypt, and the UAE are all adding. But Tuesday's decline illustrates the friction. When oil surges toward $110, U.S. Treasury yields rise alongside inflation expectations. Real yields, nominal yields minus inflation expectations, briefly firmed, and gold, which earns no yield, sold off against that move. Morgan Stanley moved in the opposite direction this week, cutting its gold price forecast by nearly 10%, citing the same real yield dynamics. The same session saw U.S. technology stocks fall sharply. The Wall Street Journal reported that OpenAI's revenue growth and new user additions fell short of internal projections, with CFO Sarah Friar warning that without faster top-line growth, the company could struggle to meet future computing contract obligations. Amazon separately struck a deal to sell OpenAI technology after Microsoft ceded exclusivity. The tech sell-off fed into Canadian equities, with the TSX declining led by technology. Energy was the exception. Canadian natural resources jumped as crude surged above $100. The synthesis across all three threads is this: the oil shock is simultaneously keeping inflation elevated enough to freeze rate cuts, generating windfall for Canadian energy producers, validating Shell's $16.4 billion strategic bet on Montney gas, and suppressing real yield-sensitive assets like gold and long-duration tech. The weight of evidence points toward a prolonged elevated oil environment sustaining Canadian energy outperformance, but only if the Iran conflict remains unresolved long enough for new infrastructure commitments to lock in. If a ceasefire materializes faster than the market expects, Brent retreats, the inflation overshoot fades, the Bank of Canada's hold becomes a path back toward cuts, and the gold thesis reasserts. The verification benchmark is straightforward. Watch whether the Bank of Canada's Wednesday statement signals any upward revision to its inflation risk language. If it does, the rate hike timeline pulls forward and the dollar firms. If it does not, the Bank of Canada has effectively told the market it is willing to run above target on headline inflation to protect a fragile economy, and that is a different story entirely.